Welcome to CFRA Thematic Insights, where we explore the market trends and investment themes shaping tomorrow's opportunities. My name is Garrett Nelson. I'm Senior Vice President of Equity Research at CFRA. I primarily cover the auto industry, and I want to talk about a few trends that are worth highlighting that we wrote about in a recent thematic report. First, this presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. The three trends, first, the year-to-date sales of the largest US-based auto manufacturers have been disproportionately weak relative to the overall market. So overall new vehicle sales were down 3% in the first half of this year, with US auto manufacturers like GM, Ford, and Tesla suffering much steeper declines. Second, China. Domestic demand has been alarmingly weak in China so far this year, which has driven a surge in exports, which has major global implications for the auto industry. We'll talk about that. If you look at the global auto industry so far this decade, this is probably the most disruptive trend, and it's going to affect the entire industry, manufacturers and suppliers everywhere. And then third, interestingly, some US auto manufacturers and suppliers announced a strategic shift beyond the auto industry into other more promising end markets, higher growth markets in the first half of this year. We'll cover that too. On the first point, so this table shows the first half 2026 sales of the top 10 auto manufacturers. And as you can see, overall new vehicle sales were down 3%. But if you look at the US manufacturers, GM was down 7%, Ford down 10%, and Tesla estimated down about 15%. A lot of the Asian manufacturers, the Japanese and Korean, like Toyota, Honda, and Hyundai Kia, all outperformed the market overall and picked up market share in the first half. Now, why have sales been so weak relative to last year? Number one, the gas price spike hurt demand for truck and SUVs, which Detroit 3 automakers like GM and Ford are so levered to. Ongoing affordability concerns, no surprise there. More difficult comps. The first half of last year was actually relatively strong compared to prior years in terms of new vehicle sales in the US. And then you had the phase out of the federal EV tax credit at the end of September of last year. You had a bump in EV sales leading up to that. And since then, you've had a significant decline in EV sales, which are weighing on pretty much every company. So that has hurt overall new vehicle sales so far this year. On this slide here on the left, this shows annual US new vehicle sales over the past decade. And as you can see, from 2015 to 2019, the market posted 5 years of historic strength in which US new vehicle sales exceeded 17 million units each year. Since then, new vehicle sales haven't rebounded anywhere close to that level. And with last year at about 16.2 million vehicles sold, that was the strongest year since 2019, since prior to the pandemic. And then the chart on the right just shows where inventories are in the US by brand, where they were at the end of June. On average, about 80 days supply. We just got the July data. It's come down since to about 75. But those numbers are still higher than the historic average for the US market of about 60 days. And as you can see, a lot of US brands are sitting on much higher than average inventory levels and higher than that 80 days supply where the market was at the end of June. On to the second point. So weak demand in China is really weighing on overall new vehicle sales, which, as you can see, we're up globally. Vehicle sales were up about 1.3% in the first half of this year, but China was down 5.4%. Of course, the largest market for autos in the world, accounting for a little over 1/3 of total supply and demand. That has really weighed on overall market. As you can see, of the three major markets, Europe has posted the strongest demand, sort of rebounding from a very soft first half of 2025. So favorable comps have helped. But the good news for China is that they're in the process of rebalancing. The production is actually down a little over 7%, so it's declined more than their sales have. And so that market's sort of in the process of rebalancing. And the surge in exports is really helping restore that supply demand imbalance. Why has China demand been so weak? Really a combination of factors, but the big ones are weak consumer confidence in the country, a prolonged property slump, reduced government subsidies, and higher fuel prices. This slide shows the surge in China's monthly auto exports since the beginning of 2020. So at the bottom there, you can see how China was exporting in January of 2020. They exported about 69,000 vehicles. In the most recent month, in June, China exported over 1 million vehicles. So that is just an astronomical surge in exports. If you look at the first half of this year, Chinese auto exports were up 53% relative to the first half of last year. This is largely being driven by EV sales to emerging markets, to other countries throughout Asia, but also there's been a big surge in Chinese exports into Europe. China's benefiting from this infrastructure campaign that they launched in 2013, really investing heavily in highways, railways, and port infrastructure. So China now has the capacity to export a lot of autos to the rest of the world, and they are doing that. So, but this has major global implications for the auto industry. Probably the number one trend so far this decade is this surge in Chinese exports, which is going to be very disruptive. We think it's going to hurt European automakers. It's going to hurt other Asian automakers. A staggering statistic is Chinese brands now account for a staggering 1 in every 10 new cars registered in the EU. As far as the US is protected by tariffs for now, but the Chinese have successfully established a foothold on both sides of the border in Mexico and in Canada with this new trade deal that they reached. Finally, as I mentioned, some US manufacturers and suppliers are actually diversifying away from the auto industry and entering into other end markets. You had announcements from BorgWarner, Ford, and General Motors in the first half of this year. First was an announcement from BorgWarner in February that it had been awarded a contract to produce a turbine generator system for the AI-driven data center market, with production starting early 2027 and estimated sales of 300 million in year one. The stock surged following this announcement, and there was a lot of enthusiasm surrounding this as the stock benefiting from a re-rating, a promising new end market, and a lot of speculation as far as what the growth might look like if successful with that venture in the coming years. BorgWarner has been the top performing auto supplier in our coverage universe so far this year, which we attribute primarily to that announcement. Secondly, Ford in May announced the formation of Ford Energy, a subsidiary which will manufacture battery energy storage systems for utilities, data centers, etc. But they have plans to deploy at least 20 gigawatt hours annually, with first customer deliveries expected late next year. And then finally, GM had an announcement in June forming a partnership with a private company to produce sodium ion battery cells for customer use beyond 2028. There's a lot of chemistry experimentation going on right now globally, looking at other chemistries for batteries beyond the standard lithium ion batteries, which are used in EVs today. So that wasn't met with as much enthusiasm, but we thought BorgWarner and Ford's announcements were positives and are very promising in terms of what that might mean for future growth. We view these things as having positive implications for BorgWarner, one of our top auto supplier picks. We have a strong buy on the stock. Ford, positive implications, although we have a hold on the stock primarily due to valuation at these levels. We viewed these developments as having negative implications for GM and especially for Tesla as more EVs or Chinese EVs make their way into Europe and elsewhere across the world. That should really eat into Tesla's EV market share and weigh on their EV sales, especially in Europe with their big factory in Berlin. The surge in Chinese exports, we think, also has major negative implications for European automakers. European automakers are very levered to EVs. They produce a lot of EVs. The fact 1 in every 10 new vehicles being registered in the EU are Chinese should weigh on sales. And then other Chinese, non-Chinese auto manufacturers. So that's it. For more insights, please visit CFRAresearch.com and see our thematic reports on MarketScope Advisor. Thanks very much.